Hi, everybody. My name is Casey Rust, and I'm the Executive Director of the Center for Affordable Housing Finance in Africa, and we are the Secretariat for the African Union for Housing Finance. I'm here with my colleague, Thandiwe Dlamini, who is the coordinator of the AUHF, and then also with our colleagues, Altair, who are a member of the AUHF, with Olu, with Michaela, and with Jennifer. And we're delighted to be here with you in this second of a four-part series on rent to own. As I mentioned just a little bit before, the video from the first series, the first session, is available, and Thandiwe will share that with you. But today we are looking at taking the story further. A quick note about the African Union for Housing Finance. For those of you who aren't aware, we are a membership body, an industry body, representing private sector practitioners of all sorts, whether it's banks and building societies, developers, consulting companies, developers, contractors, building material suppliers, prop tech agencies, the range of players that operate in affordable housing in Africa. We have 58 members in 25 countries, and we would really, really like you to join us. So if you're not yet a member of the AUHF, we would love for you to contemplate it. It's really not hard, and it doesn't cost very much money, and we do some really, really nice things. And our main event is a conference that we hold annually towards the end of the year. And this year it will be from the 31st of October until the 2nd of November in Cairo. So that's a serious draw card. I'm sure everybody wants to go to Cairo. And we're talking about a green urban future for affordable housing. And that's quite exciting too, because the COP meeting is happening just 2 or 3 weeks later, also in Cairo, to focus on issues of climate change. And so we're very keen to be able to feed an affordable housing perspective into those deliberations. So with no more delay, let me hand over to Olu and your team. Thanks, everybody. Please, if you could just introduce yourselves in the chat so that we can see who's here and so you can see one another who's here. And then if you have any questions, please record those in the chat. I'll monitor them. And at the end of the session, then we'll have some time for questions and answers. And I'll see if I can moderate the questions so that they're grouped into their logical arrangements, so that Olu and his team can answer. Over to you, Olu and Michaela.
Thank you, Casey. And thank you, colleagues, for joining us for the second of a four-part series on rent to own. And thanks for the questions we've received thus far and the dialogue that's actually taking place outside the meeting. In one sense, I think it reflects how the topic matters a lot to people. So a quick introduction about myself, and Michaela will do the same thing, and I will then introduce briefly Altair before we sort of focus solely on the content. So my name is Olanrewaju. I'm a director of Altair. I've been in the sort of housing industry, both UK and globally, for nearly 30 years. And as part of that, apart from being a consultant, I've operated as chief executive and chair of a wide range of housing organizations over that period. Michaela, I don't know whether you want to introduce yourself.
Yes, of course. So Michaela Booth, I've recently joined Altair. This is my second month as Director of Corporate Finance and Treasury. I also head up our subsidiary, which you'll have a look at in a moment, ATFS, which specialises in corporate finance and treasury advice. I've been in the social housing sector not as long as Olu, 18 years, but I have led on development, financial planning, risk monitoring, stress scenarios, growth strategies, and development appraisal and funding as well. So a little bit broad.
All right. Thanks, Michaela. So a little bit about Altair. We are obviously a UK-based firm that operates globally. We pride ourselves as being one of the world-leading independent consultancy that specializes on housing, and that's our niche. And a lot of us that are working in Altair have also been practitioners in terms of delivery of affordable housing. So we always say, yes, we can write lovely reports, but more importantly, we're more interested in the delivery side because that's what most of our practical experience are. And as a consultancy, there are four elements of Altair. We've got what we call the Aquila Group, Altair being the sort of main one. Then we've also got Oaks, which focus on sports consultancy and community development. We've got ATFS that Michaela leads, which looks at treasury and range of advice on ESG and all those related issues. And then we've got Asset Core, which is our sort of our technology platform. If you move on to the next slide, please. And this is just, I mean, we've worked for a range of institutions over this period of time. And we do have a long track record of not only providing advice, but also helping in terms of implementation as well. So next slide, please. As you expect, sorry, before we don't jump over, as you expect, we need to put in a normal disclaimer because this is obviously we're giving an overview of rent to own or products that have got financial implications. It's not a substitute for the detailed work that if commissioned will be required to provide. So, and nor are we also with this presentation selling any product. So I think it's just worthwhile to pull the normal disclaimer. So if we move on to the next item. And the reason also that is important is that we're a quoted company in the London Stock Exchange. So we have a legal duty to mention that. In today's session, we've got four main areas we're going to look at. A quick recap of the past session. Secondly, some of the issues or themes that have arrived from that. Second part of today's session, Michaela will take us through a sort of a typical transactional structure, which will be especially be of interest to a number of colleagues that are coming from the institutional investment community, because we do believe, and I think I'll continue to reiterate this, for rent to own or rental housing to play its role in the housing sector in Africa, then you cannot do it without interest of the private sector, especially institutional investors. And that's very important. So that's why we're going to spend a lot of these discussions today on looking at how we can design a product that will be attractive to institutional investors. Then thirdly, linked to that is what we call the role of community benefit companies, which we believe are our anchor that are crucial to invite investors to participate. And finally, we look at management operations, which is also that other end that is crucial in providing the assurance that actually investors will get their money back. If you move on to the next slide, please. So in terms of recap, as we said in the first series, Africa faces an housing crisis. I think I'm talking to people that does know a lot more about the challenges that provides. I think CAF and AUHF have, over the years, produced very good reports, analysis of the scale and ongoing challenge that the continent faces. And recently, I think it was last week, the World Bank also provided an update in terms of its strategy. And what's interesting is that there's a growing consensus now that actually mortgage product will not be sufficient to tackle this issue. And that if we're going to deliver volume housing, then rent and rent to own tenure are going to be crucial or important as part of addressing the scale of the problems. We covered different models of rent to own, and I will sort of talk a little bit about that as well. And then I think through the discussions that have taken place during that session and subsequently, it's quite clear that there are a number of products that, for good reasons, reflecting the challenges and the constraints developers face on the ground in terms of selling properties, what I would call payment plans have been branded as rent to own. And in some cases, we do believe, if you define it as pure, from a purest point of view, some of these are not necessarily rent to own, but they're a form of payment plans. But there's no doubt that actually they're necessary in light of the challenges and constraints developers face in terms of absence of mortgage finance. So it's not a disrespect to them, but I think in terms of definition of rental, some of them are not necessary in our understanding of rental can be labeled as such. If we move on to the next slide, please. So it then begs the question, what is rent to own? One, in our view, it always commences with a tenancy or lease agreement. I think it's important to say that. So it's always a rental product that all then have an option to purchase at a point in the future. Now, there's always at times there's an agreement for that ownership to take place through a purchase of equity, and ideally for us, we think that should be a medium term, but I know that in practical terms, because of the way finance is raised, some of them are short term, 3 to 4, 5 years. But if you're trying to make it more affordable, in our view, we need to be thinking of more of a sort of 10 to 15-year period. Sometimes there's saving schemes in place in parallel to that rental payment in order to help the potential purchaser to set aside the monies necessary to buy the property. The method in which that sales price is always explicit in terms of how the sale price will be achieved. Now, that could be an agreement that is a future valuation, taking into account some discounts, or it could be an agreed price from day one with a sort of inflationary or a method to increase, to agree to the price at the point of purchase. Responsibilities for maintenance are always clear because from the beginning, the individual is a tenant, and if under sort of normal tenant-landlord relationships, those obligations normally need to go clear. The promoter or the sponsor at times is provided with the option to purchase the property back, especially in markets where there's no secondary resale. And there's always provisions to exit, and we will sort of recommend that for tenant savings to be kept independently. And by that savings, I mean that the money that is being set aside outside of the rent, our preference is that that is always designed in a way that is independent of both parties. If the tenant or the potential purchaser is unable to exercise the option, where affordability is critical, a number of rent-to-own products are designed in a way for that individual to remain a tenant. Now, the flexibility to do that is always linked to the fact that there's access to patient where there is access to patient capital. So to some extent, and this will come back to the point I made earlier, the more we can get institutional investors in, the more we can create design products that are more flexible and products that can also meet the needs of those in lower to middle income. Next slide, please. So to sum up, we will sort of suggest the rent-to-own is usually an agreement between a tenant and a legal entity to rent a home for a certain amount of time with the option to buy it before that tenancy or lease expires. There are three main elements to it. There's a tenancy or lease agreement, there's an option to buy, and then there's a financing arrangement to purchase the property. I think I just want to make the point that in its truest form, it's not an hire purchase or sales payment plan to sell the property. It is primarily an investor product. And if we're talking about the volume that is going to be required in Africa or elsewhere or Asia, then how we attract institutional investors is going to be critical. Next slide, please. And in terms of types of rent to own, there are broadly three types. You have a rent to own where the tenant initially pays a deposit as a sign of commitment, and then with an option to buy at a future date. How the tenant purchases is purely down to them. They could either, if there's a mortgage market, they can either get a mortgage, or they can, if families can come together, or through other sources. But actually, the way the tenant exercises the option to purchase, a lot of the time is down to the tenant. And then there's an option where the tenant pays the initial deposit, and the savings scheme is set, is also agreed with the promoter, and that savings scheme works in parallel to contribute to purchase of the property. And then there's the third one, which is also prevalent in the United Kingdom, is where the tenant pays an initial deposit and then buys a share of the property, and then over a period of time buys more shares until they buy the property outright. Michaela, if we have time, we'll go through more of that. But that's also, and also she will also take you through some of the institutional structures or investment structures that need to be in place for rent to own. And importantly, I think as part of the explanation, she will then talk to you about why rent to own asset is still attractive to pension institutions in Europe and the US, in spite of the current inflationary pressures. And one of the reasons for my own analysis of why rent to own has not taken off in large scale in Africa is, as I've said, is partly the absence of institutional investors. They need to be encouraged to come into the market as they have a pivotal role to play. So, Michaela, I think I'll probably now hand over to you in terms of the next slide.
Great, thank you. Jen, if you want to just move to the next slide. I think it's fair to say that UK government, as all governments, really see the benefits, the economy of investing in housing. So both developers and housing associations support employment for local people. When a developer undertakes those works, they may take on trainees, they may develop people to deliver works in the future. And housing associations do employ local people. They need people that are in the housing neighbourhoods. So effectively, it creates employment. When people purchase new homes, they often purchase goods, and that often increases production and employment for local businesses. So again, aids the economy. And with more people in work, the pension contributions rise and the taxable income, of course, increases. And that means that there's further reinvestment in the economy. But most importantly, it does address the inequality, and it's really clear that stable, high-quality homes and communities are needed across the globe. So this is very much an area where we think government and investors should really feel that they are delivering something here that actually adds the economic benefit to those countries. Next slide, Jen. It's also very much hits the mark in terms of environmental, social and governance. So it's all about responsible investment as well. And I know that that's increasingly widespread in pension guidance and very much part of why investors see social housing or affordable housing as very much an investment that is close to their hearts. Equally, it provides the long-dated assets to match those liabilities. And in some cases, they're inflation linked, which I'll come back to. The property assets that we build can be used as collateral. So social housing in the UK has never gone into default, and I'll talk a little bit about that in a moment. But just in case there is ever an issue, the investor has complete access to the property and can dispose or rent that property as they see fit. The other thing is organisations have strong credit ratings when they have a track record. And that's because you can see that there's a stable income stream coming through. They're financially well managed. And of course, governance is highly important. So just moving on to the next slide. So we've got a direct investment fund here, which I'm afraid I think we might have just jumped a couple of slides, Jen. They're right. Okay, if we could just, that's the one. Thank you. So environmental, social and governance, I did mention, obviously very key, but ESG is hit in every occasion. And I think it's really clear to think about the amount of sustainable issuance that's been released. And to the right of the slide, you can see the Bloomberg chart. Now, over $2 trillion worth of debt is now sustainable issuance. It is a growing market and a market that is really attractive globally. Now, social housing hits all of the criteria. We develop and improve communities. We improve infrastructure. We deliver high quality homes with good energy performance certificates. We provide affordable housing, so hitting that social mark. And we see good governance. We make sure that those processes and policies are strong. We protect the assets and make sure that they remain viable. So ESG, whenever organisations are issuing ESG, they can absolutely demonstrate and report that they are hitting all of those targets. So when investors invest, they know that this isn't greenwashing. There is absolutely a good, sustainable story here. Next slide, Jen. There is, of course, the matching of assets to liabilities, which we covered earlier. Now, I'm just going to talk through some of the forms in the UK, because obviously the market's far more developed in the UK. So just to give you a slight sort of introduction. Most of the investment in the past has been through bond issuance. Those organisations are credit rated and they're listed on the London Stock Exchange. The bonds that are issued are really flexible, and they're flexible because organisations work with the investors. So if the fund managers have a requirement to secure a bond at 15 years or 20 years, organisations will issue bonds around that period to make sure that they're covering those and matching those assets and liabilities. Private placements, they're not credit rated or listed. They're private debt funds coming into those organisations very much in the same way as the bond. So collateral is provided and a coupon is set. Obviously, with a private placement, the coupon is slightly higher because it is not a tradable instrument. It is not listed. But both of those obviously have fixed income coming through based on the organisation, the underlying organisation, and the financial strength of that organisation, but these are not inflation linked. So more recently, there has been a different model of direct investment, and I'm going to talk about that in a moment. But all of these investments are undertaken by funds that either sit within the umbrella of the pension provider, so for example, Legal & General in the UK, or fund managers that are appointed by the trustees. And often the trustees are determining that investment for in respect of ESG. And it's definitely the ESG element that we're seeing coming through for most of the UK investors. If we move to the slide, Jen, that has the structure point now, thank you. So you can see here, this is a model of the direct investment. The investor fund, which is the fund manager in this instance, will issue funds into a community benefit entity. And those funds are initially via a shareholding and then a loan. The community benefit entity will develop homes for social housing. Those homes will be assessed depending on demand in the areas. So there'll be a financial appraisal and the development will need to meet certain hurdles. The development must also be of a good quality. The community benefit entity must have step-in rights and warranties must be provided. So they know that they're getting good quality assets. And the reason that the community benefit entity wants good quality assets is because they don't want to be revisiting those homes to deliver maintenance during the first 15 years of ownership. So they have to make sure that they're a great quality. Obviously, there will be some day-to-day maintenance, and that's going to be undertaken by a company I'll talk about in a minute. But the key thing is here that it's a fixed price with stage payments. So the developer has certainty that there is an income stream coming through, and that income stream will see staged payments. But it will be at a fixed price, and therefore, if circumstances change or inflation rise, the community benefit entity will not suffer that additional cost. The management and maintenance company will then manage and maintenance the homes once they've been handed over. So, of course, initially the income comes from the customers. The home will be handed over to the community benefit entity. The customers will rent or part own those homes. And then a management company is either appointed or created to undertake the management and maintenance of those homes. But that is for an agreed fee. So the community benefit entity now have an income stream coming through, which is linked to inflation. They have purchased assets at a fixed price, a known price, and they are paying the management company an agreed fee. So therefore, they have certainty of cost outflow and income is rising. So effectively, these structures are very popular with the investors in the UK because they also provide flexibility and control in a way that investors weren't getting through the bond or the private placement market. So effectively, they are allowing investors to both invest sustainably, but also for an inflation-linked return. And a number of investors are now setting up different types of structures, such as joint ventures. These organisations don't currently hold a credit rating. They're very new. They have only really been in place over the last 4 years in the UK. But of course, over time, they will be able to achieve that credit rating and issue directly if they so choose. So I just move on to the next slide now, Jen. Now, obviously, to make the fund managers comfortable, to make the investors comfortable, the sector has to be heavily regulated, and that is absolutely through good governance. The structures, the contracts, they're supported by codes of governance, policies, processes to make sure that the investment through the fund managers is protected. And we have to demonstrate that in the UK via the social housing regulator. Viability must also be demonstrated through financial planning. The fund managers here are looking at this investment no differently to any other investment in terms of bond or private placements. So they have access to the financial plan. They review that financial plan. That financial plan is stress tested. Exit strategies must be put in place, and they have to understand how the organisation will perform in a stress scenario to make sure that there is not an event of default. And that means that what they have is a very sound and stable business. Again, in the UK, the social housing regulator reviews this, but a number of these organisations are very new, and the social housing regulator doesn't really step in until organisations hit the 1,000 unit level. So a number of these organisations are not yet regulated in the same way as other organisations, but are applying exactly the same governance and regulation to make sure that investment is protected. So just moving on to the next slide. So one of the things in the UK, obviously, is there is government subsidy. And I know that there is obviously some subsidy in other countries as well. But this means that when the investors are setting up these vehicles, they're looking at really two main types of tenure. The first of those is long-term rent. And that's really simple. Customers assess for need. And this is really geared to those that don't have family support or access to mortgages, or in some cases are not employed or struggling to actually meet market rent payments. So this is an affordable rent that is around 60 to 80% lower than a market rent. a tenancy agreement's in place, and the customer is expected to look after their home and pay their rent on time. And if their obligations aren't met under the tenancy agreement, then they can lose their home, but they are provided with a safe, quality home and ongoing management and maintenance to ensure that that home remains in a good standard. And it's a long-term arrangement. And the home can remain within the family if need is demonstrated. It is an inflation-linked rent, and obviously that is set by a formula. But the key thing here is the subsidy allows that affordable rent to happen. So without subsidy, it is really difficult to deliver an affordable rent product. So the funds that I've described do an element of affordable rent, but the main product they deliver is shared ownership, which, as Olo explained, is a form of rent to own. If we go on to the next slide, Jen. Now, shared ownership in the UK, I just described that. So effectively, homes are advertised, and this is a little bit similar to a market sale home. The homes will be safe, high quality, and come with a number of white goods, let's say fridge, freezers, washing machines. So it's almost like buying a market sale home that's, you know, very well set up with high quality flooring and goods. The customer will determine how much they can initially purchase. So they can state that they wish to purchase, and in the UK, it's usually around 40% of the value. Now, the deposit will obviously then be 10% of that value, but I've just done a simple description here. The home is 100,000 US dollars. You can afford to deposit 5,000 US dollars, and so you'll own 5% of that home. And then you pay rent on the remaining 95%. But as a market sale home, you now have to maintain and manage that home. There is no responsibility on the social housing provider to support the management costs. The legals are exactly the same as buying your own home, and you will have the option to staircase further. And we call it staircasing because it's gradually, step by step, you get to home ownership. Now, you can buy more, you can buy up to 1% of the value, and you can keep purchasing as your position changes. I think the key risk with shared ownership is often organisations assume that people's circumstances will change quite rapidly, or their ability to purchase might increase more than they think. But effectively in the UK, we manage it in the financial planning world in a very low level, only assuming 1%. And after a period of time. So that means that if you have a good balanced portfolio, and again, customers are assessed day one, a number of individuals will staircase, not all of them will, but on balance, you'll arrive at around 1% per annum. If you want to exit your home, as Olu said, it's really the first option is with the organisation, and they may decide to purchase the home. In all cases where purchasing, the organisation is purchasing or the customer is purchasing, an independent valuation is always secured to make sure that the value that is being paid is fair and appropriate. And of course, as you staircase more, your rent reduces. So it makes sure that the product is less than a mortgage payment. And that's the aim of that product, is to make sure it's more accessible for those that may have funds or build funds up over time. I'm now going to hand back to Olu. Jen, did you want to move on to the next slide?
Thanks, Michaela. If I can get my video working. Okay. If you go back to, if you don't mind, Jen, to go back to that slide that has got the investor, the relationship between the investors and the, I think it's number 15 here. So one of the key responsibilities we see is this idea of a community benefit entity that provide insurance to investors. We see that they can either act both as a developer, or also they can also operate as a management and maintenance company. But again, those roles can be outsourced by any means, but there will always be the need for an entity that is providing assurance to investors. And so in terms of the management operations or the management and maintenance, if you recall, I said the relationship also always starts with a tenancy agreement. You could have instances where the maintenance responsibility is passed on to the potential purchaser. But if the arrangement is a sort of medium to long term, one needs to always operate on the basis that individuals may end up not exercising the option, and they may end up reverting being back to tenant. So somebody needs to have a responsibility for managing and maintaining the tenancy. So that's where there are responsibilities about having in place appropriate management and maintenance arrangement comes from. And in our view, this arrangement then, as I said before, it sets out, if you go back to the slide on management and maintenance, then, the other point is just why, if you go back one, yeah. So the other reason why we do believe is that if this is going to be undertaken at a volume, which is what is required, then they need to have a professional entity, or providing professional service becomes important. If you go to the next slide, please. So because of the breadth of responsibilities as a professional landlord is extensive, which will be built into the agreement, it's important to have the trained staff, you have the proper governance oversight, you have systems and policies and processes to address that fundamental tenancy obligation. An example of some of those policies and procedures we think needs to be in place to actively manage the tenancy will include range of policies that start from how you let the property, how you increase the rent, how you terminate accounts, depending on the type of development, the service charge regime that needs to be in place, the inspections that need to be taking place on a regular basis, a complaint. And you see, so there's quite an extensive list of activities that needs to be managed appropriately. Next slide, please. And that then means that the management function will also require an oversight whereby through a property, proper performance management system, it means that adequate reporting is taking place to investors in terms of how well that asset is being managed. And then there will also, in our view, need to be in place appropriate governance arrangement in terms of a board that manages, that ensures that the management and maintenance operations is being undertaken properly and in a timely manner. So in our sense, our view is that if this is to be done properly, the management and maintenance operations needs to be given as adequate attention as the financial side of things, because the responsibilities around the tenancy is as important as the execution of the purchase. And one is to bear in mind at all times that not everybody will be able to exercise the option to purchase, and there needs to be a sort of arrangement to manage the asset during that period. So that's the summation of our presentation, because I think we need to give some time for questions and deal with any points of clarification.
Thanks so much, Olu and Michaela. Thank you very much. What I find so interesting about this is the sort of shift. The shared ownership definition really helped me understand rent to own much, much better than I did previously. And I confess I was part of the group that thought that it was rent to own and installment sale were the same thing. So that was very, very useful to hear you clarify that. We haven't received any direct questions yet on the chat. There is one that's under the Q&A from Carrie Adby, where she asks, could you please expand on the step-in rights of the community-based entity?
Yes, of course. Should I take that one, Olu?
Yeah, please.
Yeah. So within the development agreement with the developer, we have seen at times that developers may struggle financially at certain times. And you may have entered into a contract with a developer who has then subcontracted works. Now, if that developer is starting to financially struggle and you've already made some stage payments that have then been passed down to contractors, and the developer themselves is having financial difficulties or may go under, the organisation can step in and work directly with those contractors and actually paying people on the ground to deliver the home so that the home is not at risk. It makes sure that the delivery is still happens. It is recognised that fixed price in those circumstances can change because, of course, you now have a different relationship and it's a contract with different people, but at least you make sure that you get your home and within the timescale set. So that's the position with the step-in rights, is about protecting delivery.
Excellent. And there's another question that comes through from Michael Kanyu. Hello, Michael, from Natureville. He's a developer in Kenya. Any examples of private investments in Africa for a TPS? I know that's a future session, but maybe a sneak preview.
I mean, not a private investment. I think I know that there have been examples of, for example, in Nigeria, there's still an organization called First World that generates, I don't know. So I know, looking at their rent-to-own product that they developed partly as part of a joint venture with the Lagos State government. And in that arrangement, they did provide like a 10-year sort of arrangements, including the service plan. So I'm quite aware that, and I think that program is still going on. How successful it has been, I don't know, but I'm aware. And I think a lot of that was not necessarily, it was funded primarily through equity and some sort of government funding as well. And I was aware that I think we did some work with them to look at how that portfolio could be sold on to institutional investors, but it was not as successful as it should be. The other alternative, I suppose, is the other examples I know were probably more vehicles that have used REITs as a sort of but they've been mainly what I call middle to high income rental products, other than what I call rent-to-own in terms of and I'm sure there's examples in South Africa, I think, but those are the ones I'm familiar with.
And Olu, why do you think that's the case, actually, that it's difficult to find some? And maybe that is what you're going to talk about at the next time. But when I look at the organogram that you've shared, and I think about the community benefit entity, and I think about the mission of setting that up, and then its sustainability as an organization, then I think about the management capacity that you've just described. And I know that in South Africa, where there is quite a lot of property management, but property management specific for this market segment, specific for this kind of tenure arrangement, that's special and difficult. So what would be your thoughts about why?
You've touched a lot. Obviously, there's a human capital or institutional capacity required to get this product to function and to work properly. There's a regulatory environment that Michaela talked about, because a lot of these organizations operate within a regulatory environment where the interest of the tenant or the purchaser is at least there's an attempt to protect it. Not always the case, by the way, but there's always, at least from a design point of view, to protect their interest. So the regulatory environment is very important. I think also why there's no sufficient institutional investors, I think, as you well know, a lot of, when I talk to a lot of pension institutions in Africa, Some do claim that the rules makes it difficult for them. People that are much more knowledgeable that can test how valid that is. But I sense it's a sort of a risk. They sort of risk averse. They don't want to be part of creating a market, so they want the market to have been fully developed, to be brought to their attention. And also, I think that I call it the addiction to fixed income security. So a lot of them prefer to just get government securities because it makes life much easier. And when you talk about diversification and issues around actually some of these fixed income securities in an inflationary environment actually are declining in value, you're having a different conversation. At least Michaela and I did a presentation to some pension institutions in Ghana, Ghanaian pension institutions about 2 weeks ago. I get a sense that there's now, because of the macroeconomic challenges a lot of countries are facing, there's some interest now, or at least looking at it. And I think we'll hopefully be working with some colleagues in Ghana to help do a more some feasibility studies around what would be required for rent to own to be attractive to institutional investors. So those will be, and then there's obviously the other stuff about supply as well, because we can focus on raising the money. The reality, as you well know with the work we did for you some time ago on REITs, is also challenges of actual supply is a problem. And also the product for sort of rent to own, you have to design them on the basis that they're going to be long-term. They're different from how you design and build products for what are called short for sales, where the developer sell and moves on. The asset owner needs to start thinking longer term. And some of those products are not always readily available. So there's a range, and then there's some of the legislative framework in order to ensure that tenancies can be managed and money collected and all that stuff. So I think it's a combination of things that I won't say it's one single issue, but
it might be nice in that fourth session or even in the next one, and forgive me for putting you on the spot here in public, is that if you could chart out in one slide like the steps. Because what you're describing is we have institutional challenges in terms of the institution itself that does this. We have housing delivery, value chain, supply challenges. We've got legal challenges. And certainly for all of us on this call, we all play different roles in those processes. And so there's an opportunity to pull in the parties to say, if we each address the issues that are part of what we normally do in our regular day-to-day job, maybe we would get a little bit closer to this. But because it will require a lot of activity from everyone. There are two comments that have just come through, and then Michaela, maybe you have a comment as well. Wally Jayasimi Olokan, and I really hope I pronounced your name correctly, asked, are any Nigerian companies attempting this product, and is it workable? And this gets to your point, Olu, with unstable inflation trends. And then the second comment comes from Irene Vance. And Irene, it's so nice to know that you're in the room. I haven't seen you in such a long time. And so Irene's comment is, she says that there's been, and I know this as well, this sense that rent to own should actually be a pathway to greater affordability, that improves affordability, but that looking at it in the context of the UK, that it's actually far out of reach for most average or low income households. So it's a particular target. It doesn't address the bottom end. And I would invite colleagues to just take a look at the chat, because I think there's some interesting points there, and maybe both of you would like to comment on that.
Okay, Michaela, do you want to pick the first one? And I'll pick up the last one.
I was going to say, I will let you pick up Nigeria, Olu, because you're close to Nigeria.
Maybe you can both do both. Go for it.
I will, yeah. So I'm happy to kind of pick up the final one in terms of product as well, but also just I think it would just be useful to kind of talk about scale and scalability, because I think that's kind of been a little bit of an issue as well, because unless it grows, and you're quite right, unless everybody takes part in this and everybody comes together, it is just not going to work. And so I suppose a plea from Altair is work with us. because actually I think we probably have a model. If you think about the UK social housing, it's been around since the 1800s, and finally, too late 2020, the investors have a product that works for them in a way that they have control over. And I think, sometimes learning from the lessons of history, where it's gone wrong, where it's gone right, and actually not making the same mistakes again would be some valuable insights. I would take that away. In terms of affordability, absolutely right. I think in the UK, there are very different, I think, it's probably the same in every city. In London, affordability is very different in every local authority. And you will have Kensington and Chelsea, where you have massive tens of millions of pounds homes, and then people living in complete poverty next to them. So effectively, it's really important that you offer that process of affordable rent through to shared ownership, because effectively there are many types of tenancies in between. There are tenancies called intermediate rent, and I have put 2 up, but there are a lot. And that kind of deals with the affordability. Everybody is assessed differently, and everybody is reviewed in terms of need. The one thing, though, is without government support, it's very difficult to build an organisation that is purely delivering an affordable rent and make it financially viable to return a payment to a funder. And that means it just doesn't work without government support. And I'm afraid that's the truth of the matter. We've been there over many years, and without funders or without government support, it truly happens. The other thing I ought to just touch on with the affordable rent is, I said it ranges in terms of market rent, and that's because somebody may not be able to afford 60% of market rent. Somebody may not be able to afford 50% of market rent. Everybody is assessed on need. And that means that everybody gets an affordable home, but the grant level subsidies have to increase to support that. And I suppose, just going back to my earlier point, it does need government involvement to make that work.
So the comment that I would have on that, just before you, Olu, quickly, I'm going to squeeze in here, is that you talk about, finally, we have a product that investors like. But then the balance of that is a product that works for the consumers, and one has to bring those two together. And that seems to be the particular challenge, and the range that you're talking about, affordability and different options, is one way of addressing that. I suspect in our context, we have fewer options available given the thickness of our markets, the relative thickness of our markets. And then you say that, well, we need government support. And so my next question would be, I know our governments don't really have much capacity to provide support. So let's be precise about what kind of support. What actually, are you saying cash? Yeah. That's what we need? Or is there something else that would change the math?
Can I come in, Michaela, just quickly before you, just to add to your response? I think the intervention of government is dependent on the income group you're trying to target. I think the theme of what we're trying to say is that the lower you want to make it, and if affordability is crucial to you, then you might in those instances need government subsidy. I think in terms of the market generally, there's a sort of enabling role government needs to play in terms of regulation, supporting institutions, legislative environment, to make it as a more attractive sector and take away some of the risks perceived by the investors. So that's where that'll be my response to the level of government. So it's not always about just throwing money at it. I think we recognize the fact, or at least I recognize the fact, that government in a lot of African countries have got a lot of competing needs, and the resources are finite. So what we need to talk about, from where I'm coming from, we need to create the market first. And that market we create may not be meeting the need of the bottom end of the market immediately, but let's create the culture and the confidence of investors that actually housing or residential housing can be an asset they can invest in that can get them a return, and the supply chain and the value chain that comes around it is functioning as a market, and that will provide confidence to government going forward about actually, how do I bring the lower end of the income population into it? Because what I tell people in the housing in Africa, housing is a problem faced by everybody, period, except for the 1% or 2% of there. So any solution you come up with, there will be segment of the population that can meet those needs. Sorry, Michaela, I just thought that context was
Oh
important.
no, absolutely. It is. And I think just to go back to your point, it's not only cash, it's land. Because the purchase of land, it can be expensive, it can be challenging at times. A number of government local authorities in the UK will have land. They will make sure it has a good clean title, and they will pass that over to the housing association in the UK to develop homes. And that means, okay, it's not cash, but it's land that will build a community and infrastructure. And therefore, they may even want to support that delivery, because we can actually then create something. So, for example, new roads that they may have been spending funds on in any case, the land and access that comes with that. So it's working in partnership. So I mentioned joint ventures. Joint ventures is another way of doing this. Developers often may have land where they feel that demand may be more geared towards a shared ownership rent-to-own product, and therefore working in partnership with organizations and with government, I think, will be key to kind of cracking this. But effectively, Olu's right, we've got to start somewhere. And the stronger you build those organizations, the more they can reinvest in different types of affordable housing.
Yeah, absolutely. And I mean, I think what I'm hearing you both say is something that colleagues have heard me say also, is like, well, we need data, because we can't make any of these arguments and we can't prove any of what we're talking about without data, and not like the high level stuff, which I'm very good at talking about, right? But the detail, the proper math, and how it works and where it works. I mean, this comment from Irene also about what is affordable rent versus social rents in the UK, and that that word affordable becomes almost, it's a meaningless word because it doesn't really apply and all. So we need the actual numbers, and I would like to challenge everybody to stop being shy about sharing your data, because how else are we going to learn from this and build something that actually works in the particular context? It's something that CAF, something that the AUHF are working very hard to do, but everybody in this room, please, to share the data around these kinds of things. And we need good case studies, Olu and Michaela, about like, what is it that practically makes these models work? A nice suggestion from Michael Kanui, who says that maybe you could share a simple model that would work in the African context, given your experience, almost like so we have a step up to the model we're looking for, right? I know that when we started to think in South Africa, it was about 15, 20 years ago that I was working on a project saying, could we even consider shared ownership? The response back was that would be a very difficult thing for tenants to get their heads around. And certainly we've had a very difficult experience in this country for a range of reasons with the cooperative model as well, because who does what and where does the equity actually lie? So there's lots that needs to happen before we can get to an approach that works practically. We've come to the end of our hour. I wonder if either of you have any concluding statements.
I think my sense would be that, look, this is an ongoing discussion. I don't think the purpose of this exercise is not to sort of finish all the dialogue. I think is getting the principles in to have the discussions around it. There's definitely an opportunity to do more detailed work, and one of the things we're looking at now is to talk to DFIs and to undertake proper feasibility. So what you're talking about, the level of detail you still require a lot of data gathering in order to do proper feasibility study, due diligence, and also understand actually how that could be structured, taking into account some of the sort of local constraints, which would be different from one country to the other. So that's where we are in terms of trying to get some of these ideas translated and practiced on the ground. So if people are aware of institutions that are willing to get us to get under the bonnet and come up with how this can be worked, then please send the details to us. And secondly, I think we need a number of pilots as well. This is always the case. These pension institutions need to see evidence that it's working on the ground. So you always need to have some pilot examples, and then that will give them the confidence. I don't think business case would enough is enough, although what we think might be attractive is that seeing what other pension institutions are doing in other parts of the world might be attractive. I mean, for example, Michaela, I think alluded to, you've got Legal and General in the United Kingdom, not only setting up companies that are managing properties, they're also setting up huge off-site manufacturing factories to build homes and this is a pension institution. So that tells you that they're not all mad. This is something there as part of their long-term liability. So we keep on pushing it to our pension institution in Africa. Say, look, you're custodians of long-term responsibilities. Then you need to have diversification of tenure of products to meet that.
Yeah, absolutely. And that argument, that's an argument that both CAF and the AUHF really want to make. And we want to go and talk to the pension funds. And so we'll do that with you, and maybe we can go there together with this collective experience. But really, that we have to figure out how to build that argument, while at the same time, everybody else in the room, all of the other parts of the pieces, to put them together. I think that we've created some good interest and enthusiasm for the next two sessions. When is the next session? Remind me. It's coming up soon, but I forgot.
Is it 8th or 9th of September, I think?
It's coming up quite soon, so we'll send out a notice about that. Jennifer, do you know?
8th of September, yeah.
Yes.
A couple of weeks away.
Fantastic. Okay, that's great. So enough time to digest. We will post the video for this and the presentation. As before, I think that Olu and Michaela will be available for any offline questions. And really, thank you so much, everyone, for the discussion and for the participation. Thank you, Olu and Michaela and Jennifer, for presenting today and for sharing your insights and your great experience in this with all of us. Thanks, Thandiwe, for bringing us all together.
Yeah. Cheers, guys. Thank you.
Thank you. Thanks all.
Thank you.
Bye.